Hey everyone, in this video I'm going to compare two really cheap stocks against each other and determine which one is the best one to buy. Now remember, when stocks are really cheap, they are usually cheap for a reason. The market has sniffed out something about these stocks that has bid their prices downward. And when I'm talking about cheap stocks, I'm not just talking about cheap in terms of price of a stock, right? The market price is not the only thing that determines if a stock is cheap. More so, what makes a stock cheap, in my view, is the price to earnings or price to free cash flow. It's what you're getting in return for the price that you're paying. If you're not getting too much in return to what you're paying, then the stock is not really cheap, right? Even if it's just $1 per share. So I'll talk a little bit more about that in the end of the video when I'm making that decision on which one of these two stocks is the better one to buy. But let's get into the meat of this video. Let's compare these two stocks at the beginning, looking at their short-term prospects, starting with ZIM, which saw its revenue collapse to 1.37 billion in its most recent quarter, down from 3.72 billion, and that led to a loss per share of 50 cents, down from an earnings per share of $14.19 the same quarter last year. What a huge drop off. Remember, I said there's a reason why these stocks are cheap, and there's a fundamental validation that justifies why this stock is cheap. Now, ZIM is a global shipping company, and shipping rates have collapsed since the peak during the pandemic, and the lower shipping rates makes it harder for the company to generate profits at its existing scale, so it's got to make a lot of adjustments to return to profitability. The next cheap stock I'm going to look at is AT&T, which saw its revenue increase by 1.4% to 30 billion. Still, its earnings per share also fell to 57 cents, down from 65 cents in the same quarter the prior year. Now, of course, if you're in the business of selling wireless connections and all that, that's not a growth industry. Pretty much every person that wants a cell phone has a cell phone or a smartphone, has one already, has a connection already. There's limited opportunities for growth. And to make matters worse, Amazon is considering launching its own wireless service, which could put even more competitive pressure in the industry that's already facing increased competitive pressure. Remember, before, let's say 5 years ago, it used to be mostly AT&T and Verizon that were dominating the industry. They were both keeping prices relatively high, not competing against each other. That was really good for industry profitability. In recent years, T-Mobile has jumped into the fray and offered competitively lower prices, and that's bringing down industry profitability, and AT&T and Verizon are needing to respond either by lowering prices or experiencing a mass exodus of customers over to T-Mobile because T-Mobile offers lower prices. To add to the mix, Amazon's consideration of jumping in, that makes industry profitability prospects even worse. It's no surprise that AT&T's stock price has been under pressure and why it's trading inexpensively. Let's look at the longer term prospects. Let's go back a couple of years and let's look at the operating profit margins of ZIM and AT&T. ZIM experienced a boom in operating profitability because remember, supply chain shortages, people spending more time at home, spending less money on services and more money on goods meant we were ordering a lot more things that needed to be shipped overseas, and that created an absolute surge in shipping prices, which was all great news for ZIM. However, the company is experiencing the opposite of that, as we noted, and its operating profit margin is on its way down. Would not surprise me if this turns negative over the next couple of quarters. Meanwhile, AT&T has maintained a relatively stable operating profit margin in the mid to high teens, and I suspect that will continue to be that way, even though AT&T's revenue growth might stall or it might decrease. Its operating profit margin, I suspect, will remain relatively stable, at least in the near term. That is, unless Amazon jumps in with some innovative, extremely low price service that really sends the industry downward. Finally, let's look at valuation, and looking at the forward price to earnings ratio of AT&T and ZIM, you can see AT&T is trading more expensively. However, AT&T's profitability is likely to remain positive, while ZIM could experience negative earnings over the next few quarters, as some analysts predict. So if I had to pick one of these really cheap stocks to buy, remember when I say really cheap, I'm talking about price to earnings, right? It's really cheap compared in when you're looking at price to earnings of 6.6 and 0.4. There are some stocks that are trading at forward price to earnings of over 200, 300, and 400. So a price to earnings of less than 10 is considered cheap in my book. So the best cheap stock between these two to buy right now, in my opinion, is AT&T. I would pick AT&T right now. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.